Hey now, it's Bill with Smart Trades, and it's Friday, March 18th. We're coming up on noon Pacific time. And today I'd like to do a little bit of a review of calls that I made back in February, early February, and earlier in March as well, and see how they've panned out. Additionally, I'd like to talk a little bit about the benefits and the shortcomings of technical analysis, and Elliott Wave in particular, obviously. But first off, this chart was from a report that I actually issued, I believe, on the 8th. There might have been an initial report also on the 7th. You see these light gray lines; those were the projected path of breadth and so on. And then you can see how it turned out on the short term. At that time, and keep in mind this is prior to the earthquakes and prior to the problems in Libya, I had a target of the 1270, 1275 area for the next intermediate term decline. Simply, I was looking at the previous fourth wave of one lesser degree on the charts as the next likely technical target for the market. And anyway, here's how things worked out. What I had mentioned there back on the 8th was to look to sell against these longer term trend lines. I've got them in pink here. And do so when you had bearish divergences on the breadth ratios. And indeed, the first two, although they produced short-term declines, did not produce a top. Third time's a charm, and indeed we tested the top of that channel, actually broke through it very slightly with a bearish breadth divergence, and indeed that obviously, in hindsight, is the intermediate term top. And here's the pattern down from there. Quick note that we do have a bullish breadth divergence on the recent low. Here again is that previous fourth wave low. Obviously, we've exceeded my target of the 1270, 1275 area, and indeed, it remains to be seen whether or not that's a bottom or not. That said, given the circumstances and the fact that call was made, about 6 weeks ago, I think that it's pertinent to see that indeed the basic scenario projected by the technicals took place. Also, I'd like to bring your attention to a new indicator that I'm using. It uses a function of breadth, and you'll notice that it had a divergence right off the top as the advanced decline line did, but it also managed to cross its moving average and basically point down through the entire C wave of this pattern. And again, going back to that Elliott analysis, my favorite pattern here, and it has been for some time, and although I have had alternate counts, I have mentioned that my favorite scenario was that we had an A down, a triangle B wave, and from there should be a 5-wave pattern of C down to complete a ABC off the high. And note again that we have a bullish breadth divergence actually crossed this moving average just prior to the low a couple of days ago. Here again is that pattern basis the cash. Here's the bearish breadth divergence on the NYSE advances, bullish off the low. And I think that this is indeed the best count. Now note that it is still certainly possible that this can be counted as a 1-2, and that this is just a third wave or perhaps even one of three. Although the higher that we rally, the less likely that indeed this is a third wave, because once it overlaps with one, it will negate that scenario. I believe that's around the 1294, 1295 area. So an area to watch. Also right now, today we've tested the very short-term previous fourth wave, 1288. Probably one of the most reliable and important things about Elliott is that previous fourth wave support or resistance, and indeed some really good examples of it here in recent market action. You may also remember back in early March I talked about Apple. I said that if it failed at 360 and headed lower, that likely the market would follow. And obviously that has indeed occurred. We did briefly punch through 360, but we weren't able to hold there even for, I believe, an hourly close. This is a 130-minute chart. And you can see we punched through there very briefly and then fell like a stone. And here again, previous fourth wave support. This is not as pure a chart as the S&P, and you shouldn't expect it to be. You're not going to see the kind of mass participation in an individual stock that you will in the broader market. Nonetheless, we do have what we can label here as a previous fourth wave. We've come down and drilled it on the lows, and we can count that as an ABC. One thing to note here is that C waves usually are five-wave structures, and indeed it looks like we've got 1, 2, 3, 4, and that we may yet have one more new low in Apple. You can see that better on the 130-minute chart here. Again, not a perfect Elliott pattern, but 1, 2, 3, we perhaps are still working on 4, and then we may need a fifth wave of C to complete the pattern. And that will probably cause the market to follow lower. This again is an older chart, and I had mentioned the possibility that we were going to rally up to the 1350, 1370 area basis, the S&P. Actually, I'd like to extend that out to about 1380. That's where the 0.786 retracement comes in. And here, here is the weekly chart of the S&P, and a little more detail on that count. Again, as you all know, we were calling this a corrective rally off of the lows in 2009, and from there A, B, and then here is a five-wave structure that I think best counts as being still in progress. And you have one up, two down, a five-wave structure complete to 5 of 3, and then what we're working on now, at least in my opinion so far, best counts as a fourth wave, or perhaps A of 4. The implication of that is that we've got one more new rally to make. You'll have several targets cluster in the 1350 to 1380 area, not the least of which is a 1 equals 5. 1 equals 5 comes in just about 1365. So I don't expect much higher prices if this count pans out the way it's outlined here. But certainly the possibility exists that if the situation in Japan can be brought under control, there'll be a bit of a relief rally. Likewise, the situation in Libya and so on and so forth. All things considered, I think the market's held up remarkably well given the severity of the world's problems at this point. And again, the note here is that the market is basically following a technical pattern in spite of very serious fundamental problems in the world. On that note, on the shortcomings of technical analysis, obviously something still could go horribly wrong in Japan. I hope it doesn't. The market is indicating that it won't, but there's free will. The market, the world, things happen, and obviously something could go wrong there. And indeed, if it goes much more wrong than it has already, we could take out these lows, and indeed the top could be in. And that's why we have alternate counts and understand that nothing here is written in stone. We have a favored count, and then we have an alternate so that we have a roadmap in case we're wrong. The dollar index, and a good example of seeing when you're wrong quickly. The dollar index, I think, is still trying to bottom. However, I had mistakenly called for a bottom a few days back. From there, I noted that we had an ABC rally right to the trend line, and that indicated the probability that we were actually going to make new lows. I think one of the most important things in trading is to realize when you're wrong and act on it quickly, and that ABC rally certainly set the stage for that. We may yet be putting in a bottom, but that ABC rally was a red flag. And on that note, a lot of folks are just mistakenly using Elliott to basically rationalize their point of view. And just to go back, there's one analyst in particular is calling this structure an impulse wave to the upside. Incredible to me, because you can see the very clear ABC pattern up. Likewise, he had called this pattern an impulse wave. Again, ABC. It's if you're trying to call it something else, you're really not looking at what's right there in front of you. So the most important message in Elliott or in applying Elliott is, trade what you see, not what you think. On that note, and fitting into this scenario with a potential dollar bottom is a possible peak in gold. This chart is somewhat dated, but we do have 5 waves up to a new high, and it's possible that gold is peaking. Moreover, the bond market also has carved out an ABC to the upside. This perhaps is just a of a larger correction. We'll deal with that as time goes by, but for now you have a potential ABC up, a failure right at A equals C, and so the potential exists that the bond market has put in a short-term peak and a corrective rally at that. So definitely another thing to note here. And an old friend of mine used to say, it's simple, but it's not easy. Well, classic case here. I mean, looking at the market, analyzing it, seeing the patterns for what they are, it is literally as simple as ABC. Actually trading it is another matter, obviously, and difficult for all of us. The crude oil market, I think this best counts still as a corrective rally, and indeed the pattern off of the highs I think best counts as an impulse. Whether that's A of a larger correction or an important top remains to be seen. We have a somewhat ambiguous rally off of this low, and this is a low confidence wave count to say the least, but if the recent highs up above 106, closer to 107, are not taken out, it is possible that we've got a longer term correction or even a change in trend off the top in crude oil. Anyway, that's about it for now. Hope you had a good week, and good luck in the week ahead, and let's hope that those guys in Japan, who are risking their lives, are successful in taking care of the situation there. It's just a very difficult situation, and again, on that note, as far as the markets as they relate to the nuclear crisis in Japan, I'm certainly not. We can't predict what's going to happen there. So, if indeed we take out the recent lows, all bets are off in terms of the idea that this is a corrective decline. But to this point, we have to again trade what we see, trade what's there on the charts, and try to take it from a unemotional point of view, and not be biased by our hopes and fears and thoughts and so on, and just trade the market for what it is. And so far, the decline in the S&P best counts as an ABC and a corrective decline. So let's hope it holds, because that's probably good news for Japan if it does. Anyway, thanks so much for watching. Have a great weekend. Thanks. Bye-bye.